Hello guys, this is the second episode of the Introduction to Option series. In the last episode, we saw what the different types of options were, the call option and the put option, and the difference between an option seller and the option buyer, and the returns and risks of the option buyers and the option sellers, and when the call option goes up and when the put option prices go up, and in which scenario do you buy and sell which option. We discussed these topics in the first episode, so today we'll dive deeper into this subject of options and see how the basic terms related to options and how the option prices are determined. So so the spot price, strike price, and the expiry, these three, and the option premium. So these four terms are the basic fundamental uh, terms intrinsic to any option. And so let's look at what these are in detail. So for this, let me take an example for you guys. So let us consider this Nifty 14,700 call option as our example. So for this Nifty 14,700, the spot price would be the current level at which Nifty is trading. So that is 14,744. That would be the spot price for this Nifty call option. So 14,744. Let's write that down. 14,744. That is the spot price for this call option. Now the strike price. What is the strike price? So the strike price is the price mentioned here, 14,700. All these strike prices are unique to each option. So for this it's 14,700, for this it's 14,800, and so on. So this number, and for Nifty there are strike prices at intervals of 50. So if I search 14,000, there's a option with strike price of 14,000, 14,050, 14,100. So these increments of 50 is for Nifty. There are increments of 100 for Bank Nifty, and the increments depend on the current spot price value levels. So for Nifty it's increments of 50. These are the strike price. So for this the strike price will be 14,700. 14,700. And the expiry for this, it says Nifty March 14,700. So what this means is it is a March expiry option, and the expiry is on the last Thursday of March. So for March, the last Thursday is on the 25th. So that is the expiry date for this particular option. So for this it would be, expiry would be 25th of March. Now what are these and how do these work? So these we are discussing for the context of a call option. Okay, call option is denoted by CE. So what this means is you have a buyer and a seller. You have an option buyer and an option seller, right? So also the option premium for this. The option premium for this is the rate at which it's trading right now, which is 183 as you see here. So for this option, for the 14,700 call option, 183 is the option premium. So let me write that down as well, 183. Perfect. So that is the option premium. Now how options function is, what an option basically is, it is an agreement between the option buyer and the option seller. So suppose for this option we have a strike price of 14,700. So the call option buyer agrees to buy this from the option seller at the price 14,700. That is the agreed upon price. So and on the date 25th March. So what this means is the buyer pays the seller a fixed amount. This amount is 183, which is the option premium. He pays 183 to the seller for the guarantee that the seller is going to sell him Nifty. He is going to sell Nifty at what price? At 14,700. at this price on, this is the important part, on 25th March, on the 25th. So what is today's date? So today's date is 20th of March. So the, the seller would be selling Nifty to the buyer. So the buyer would be buying Nifty from the seller on at 14,700, irrespective of the level where Nifty is on 25th. He would be getting one Nifty for 14,700. Now in the context of stocks, he would get one stock at this strike price. So since we are discussing for Nifty, so the buyer would get the seller get the Nifty at 14,700, and then he can sell it at the spot price of whatever it is on the 25th of March. So that net amount is his profit or loss, and this 183 is the initial investment or the payment he makes to the seller. So how is this 183 decided? So how this 183 is decided is, the option premium consists of two components. One is the intrinsic value and one is the time value. So what is the intrinsic value? What is the time value? So we've seen that 183 is the option premium for this particular call option of 14,744 is the spot price of Nifty and strike price 14,700. So what is the intrinsic value for this? The intrinsic value of a call option is the spot price minus the strike price, right? That's that. Now this is because the buyer is buying the call option for 14,700, that is the agreed upon price, and he gets to sell it in the spot market for 14,744. Now this profit of 44 is what he's getting. He's getting it directly, right? He does not have to do anything at the current levels. So this 44 difference is the intrinsic value that the option already has. So if right now this exchange takes place, the buyer already gets 44. So this 44 is the intrinsic value of this particular call option. So the intrinsic value is the spot price minus the strike price. Now what is the time value? The remaining value is the time value. So your time value here is 183 minus 44, whatever that is the time value of the option. Now what role does this play? So right now the intrinsic value is 44 and the buyer is paying the seller 183. So this 183 he's paying in the hopes that Nifty rises even further to a level it is right now. So suppose from 14,744 Nifty hits 15K. So let us say Nifty is at 15K on the 25th of March. So what would his profit be? He would be buying it at the level 14,700 but selling it at 15K. So this net profit of 300 he gets. This is the net profit he gets on the 25th of March. But he has already paid an option premium of 183. So minus 183. So he's getting 300 and he has paid 183 before itself when he entered the contract. So this 300 minus 183 would be the net profit. That would be around 117. So this is the net profit if Nifty is at 15K on the 25th of March for the call option buyer. Now for a put option, the put option is very similar to, but it is the exact opposite. Now let me clear all this. So put option also has a spot price. Let me just write spot, a strike price, and expiry and premium. Again 4 terms: spot price, strike price, expiry and premium. Now the example for this, let us take the 14,800 put option. Now the 14,800 put option, the spot price is again the nifty value of 14,744, same 14,744. The strike price is the 14,800 PE right here, the bottom one we are considering. So the strike price would be 14,800. Expiry is again March. This is the March contract, so the last month of March, which is the 25th of March. So 25th of March. Now the option premium here is 178.6. That is the level it is trading at. So 178.6. This is the option premium. Now for a put option, what these values represent are, for a put option is represented by P. So the buyer, again here as well, the buyer pays the premium to the seller. That is, buyer pays 178.6 today, right now, to the seller. What he hopes is, what this agreement means is, buyer pays 178.6 to the seller, and in the future, on the 25th of March, let me edit this. On the 25th of March, he agrees to sell one nifty at 14,800. He sells it to the seller. He sells the nifty contract to the seller, not the contract, I'm sorry, one nifty to the seller at 14,800. Now suppose nifty spot price is currently 14,744. Suppose it stays same at 14,000, or let's say it comes down to 14,700, right? Now this is what the current nifty level is, not the current level. On the expiry date on the 25th March, let's say nifty is trading at this level, but according to this agreement, the buyer can sell nifty at 14,800 to this guy. So this net profit of 100, this is his profit. He gets to keep this. According to his agreement, he's selling it at 14,800, but the current price on the 25th March is 14,700. So this 100 he has as his profit. Now this premium he pays to agree to this deal, right? So this premium again is intrinsic value plus time value on today. So today the intrinsic value for a put option is the opposite. It is the strike price minus the spot price. In the previous example of call option, it would be the spot price minus the strike price, but here it would be the strike price minus the spot price, because here in the case of put option, you're selling the stock or the underlying asset at the strike price and buying it back at the spot price. So that would be the intrinsic value currently. Now 14,744 minus 14,800, that is 66, is the intrinsic value, plus you have a time value. Now this time value, again you have 178 minus 66, that is your time value. So this 178.6 you are paying for the guarantee that you can sell one nifty at 14,800 on the 25th of March to this guy, to the option seller. Now this is what is involved when it comes to put options, and this is how the this is what the option premium means, the expiry means, the strike price means, and the spot price means. So that's it for today, and we will delve deeper into options and see how the prices of options change as the stock price increases or decreases or goes constant. That's it for today. Thank you.